Welcome back. Now, it's no secret that South African households are under financial pressure, and with Finance Minister Enoch Godongwana's VAT increase of 0.5 percentage points from the 1st of May, with a similar increase penciled in for next year, the cost of living is set to rise. Goods and services will become more expensive, transport, clothing, electricity, and food, even though more items have been added to the zero-rated VAT basket. Household budgets will take further strain. Sanisha Packirisamy, chief economist at Momentum Investments, and Neil Roots, CEO of Debt Rescue, join us for more insights on how the VAT increase will affect your pockets and how best to manage it. Neil, Sanisha, thanks so much for your time this afternoon. Now, a very contended issue even led to the budget being delayed in February. We've moved from a 2 percentage point increase to a 1 percentage point hike over the next 2 years. Might be lower, but still putting pressure on the consumer, right, Sanisha?
Thank you so much for having me. Yes, indeed. So, we've come out of an environment where South African consumers are extremely cash strapped. And we've seen that, household incomes have come under significant pressure in the last inflation cycle due to high food and fuel prices. And I think this is still taking out of consumers' wallets now at a time when we are, facing a value-added tax increase.
And that really just adding further pressure on the consumer, and I mean a consumer that's also at a point where it has quite a lot of debt, even though we are seeing those interest rates coming down, right, Neil?
100%, and we must realize that almost half of all credit active consumers in South Africa are over indebted, and that's why this is going to hit consumers extremely hard because of the fact that obviously, as we know, the VAT will impact most of the goods and services, and our consumers can just not afford that at this moment.
Sanisha, just talk to me about the kind of effect or impact this VAT hike could have on inflation.
Sure. So what we've seen from National Treasury is an estimate that for the 0.5 percentage point increase in the VAT rate for fiscal year 25-26, it should add about 0.15 percentage points to the headline inflation number. And if we get that additional 0.5 percentage point increase for the following fiscal year, it will add an additional 0.15 to the inflation number. Now, remember that as it adds to inflation, it does take more money out of consumers' pockets, so it can also have an impact on GDP growth rates. And again, Treasury is estimating that for the 0.5 percentage point increase in the value-added tax rate, it can shave off about 0.07 points from your overall GDP growth rate. I think, talking about inflation, there are a couple of things that we need to bear in mind. I think there are some upside threats coming through from an additional hike in the value-added tax rate, but there are also some upside pressures coming through from potential tariff increases from the US economy onto South Africa. At the same time, there are also some downside pressures coming through from a basket which has just been, reweighted, and I think there is a bit of a downward bias in those figures, as well as the electricity tariffs, which came out substantially below what Eskom had initially asked for, but also below what the South African Reserve Bank had penciled in for their figures. So there are a couple of things at play. I think fortunately for South Africans, our current headline inflation numbers are operating closer to the bottom end of the 3 to 6% target band rather than the upper end, and so that does give us a little bit of space to stomach the blow of that.
And just talking about that target range, I found it very interesting because the last time Governor Lesetja Kganyago did speak on it, he did say that they are waiting for Treasury to approve the plan. But I guess with this VAT hike coming in, we might not see that target being reduced anytime soon.
I think, there's a big push to try and reduce the inflation target in order to ensure that it's operates more within line with our trading partners globally. And ultimately, a lower inflation target does mean that ultimately we get lower inflation and lower interest rates, and that will be a benefit for consumers. I think we need to look very carefully in the inflation cycle where we can potentially reduce that target. And I think a couple of issues first need to be ironed out, and a lot depends on National Treasury as to whether or not we will actually see a reduction in the inflation target. What we do know from the Reserve Bank side is that they have been pushing for it. Of course, this is quite a long consultation process, and quite a bit needs to be taken into account before we can actually move to a low inflation target in South Africa.
Now, Neil, let's look at some of the measures in place to cushion the impact of the VAT hike. Sanisha mentioned one of those measures where Treasury is looking to add more items to the zero-rated VAT basket. They're also looking at increasing social grants. Is this enough?
Unfortunately, I don't believe it's enough. It's not nearly enough. Like I mentioned earlier on, almost half of all credit active consumers are over indebted, and much more could have been done. For instance, awareness of the remedies for people who are over indebted, like the National Credit Act. It's one of the best acts of its kind in the world. We've got first world countries coming to South Africa to try and learn from this legislation and how we're helping over-indebted people. But the tragedy here is that people don't know about this act and the help that it brings in the form of debt counseling, for instance. So I believe that would have been much better. And also, spending time and money on financial education, making our people financially literate, because that's one of the biggest problems that South Africans are sitting with, is the fact that they're not financially literate. They don't know how to save, they don't know what to spend their money on. They fall for all these marketing antics of a lot of retailers, providing them with credit to buy everything on. We even see people buying their groceries on credit. So there's no way, once you hit the stage where you're buying your groceries on credit, that you are going to get ahead. And the reality is you're just going to fall deeper and deeper into debt. So I believe that, the measures that has been put in place is not nearly enough to even touch the over-indebtedness of South Africans.
Neil, then talk to me about how we can then build a country of citizens that do prioritize saving, especially when, a lot of citizens don't even have enough to get by during the month. I'm even thinking about how squeezed the middle class is becoming because of, the economic environment we're living under.
100%. And like I said earlier on, it all comes down to financial literacy. And I believe that what we can do is educate people. Educate people in terms of how to deal with their money, how to draw up a budget, how to stick to a budget. And also, when they do become over-indebted, what to do in that scenario. Is there help? Yes, there is help. We are very fortunate in South Africa to have help in that regard. But people are not educated around that. And like I said previously, the tragedy is that debt counseling, for instance, has shown a magnificent success rate in assisting people. But we don't see government doing anything making people aware of that remedy, assisting people who are over-indebted.
Sanisha, Neil talks about going back to the basics and drawing up a budget, knowing how much you earn and how much you can spend with what you have made. And I think something that was quite important that caught many people's attention in the budget was the bracket creep, when your salary, increases due to inflation, but tax brackets are not adjusted accordingly. As a result, of course, you may end up paying a higher percentage of your income in taxes. How concerning is this move? Because it is the second year in a row it's happened, and it's ending up to people making less or earning less.
Now, that is quite a big problem, especially for your middle income group in South Africa. We always call it, the silent killer. It's quite amazing how much airtime the VAT rate increase gets, and that's expected to collect about 13.5 billion rand in fiscal year 25-26. Yet the amount of money that government expects to receive from bracket creep alone is 18 billion, and we're not nearly seeing that get as enough airtime. And if we look at the last couple of years since the global financial crisis, on many instances, we haven't actually seen full relief being given across the board to all income earning groups, specifically the middle income sector, which has been, experiencing quite a lot of that fiscal drag over the last couple of years. And why we say it's the silent killer is that it's far more difficult, to calculate what you are paying in terms of the losses through bracket creep, and more easier to kind of get grips to, what you're paying in terms of extra VAT on items. And I think that going forward, this is going to be an ever increasing pressure on your middle income bracket. In South Africa, the low and vulnerable households do get protected by things like an expanded list of your zero-rated VAT items. We also saw in the budget that local governments do tend to fund utilities for poor households up to around 650 rand per month. But when you start getting into your middle income buckets, that's kind of, your area that is seeing quite a lot of stress coming through in terms of the pressure on their household incomes.
And how do we go about protecting that middle class household, considering that the more pressure they face, they could then drop into that vulnerable income household space and then rely more on the government. So we now have more people on these social grants.
100%. So we've seen this playing out in the past where we've had your middle income bracket, according to the COVID-19 pandemic crisis, quite a few of those actually ended up in the more vulnerable groups in South Africa. And again, to Neil's point, some of these consumers are also quite heavily indebted. So what we do need to see, aside from the, financial education, are some spending and, behavior patterns that shift for your middle income bucket. So for example, ensuring that you are spending on your essential goods rather than the discretionary or luxury goods items, trying to make use of shopper discounts wherever possible, trying to ensure that you can do your purchases in bulk to get those additional discounts, having an emergency savings fund, and even if you're not able to put a lot into that savings fund at a time, ensuring that you do it for it frequently and regularly will then essentially build up those savings over time. Now, as we move from 2024 into 2025, we are expecting that households will see some alleviation in pressure because of the two-part withdrawals that are likely to come about, a little bit on the employment gain side, a little bit of relief from lower interest rates, especially for those debt-burdened consumers. But that additional income that is in the pockets of consumers then needs to be looked at quite carefully instead of just being allocated to luxury or discretionary goods spend.
Sanisha, Neil, thanks so much for your time and just sharing your insights this afternoon. That was Sanisha Packirisamy, Chief Economist at Momentum Investments, and Neil Roots, CEO of Debt Rescue.